what's up everybody? It's your mortgage expert, Brian McCauley here. So you're looking to buy a house in Dallas, Texas. You're unsure of the type of financing that you qualify for. Stick around. In today's video, I'm going to teach you the secret 2025 FHA guide that shows you everything you need to know about buying a house and getting an FHA loan. Let's get into it. So listen, DFW is still heating up when it comes to buying and selling houses. There are a lot of available mortgage programs out there for different styles of buyers. Today, we're going to be getting into the FHA buyer. I will tell you, in 2025, the FHA buyer has more options than ever. I'm just going to start with the incredible news that on a single family residence in a DFW county, you can get a loan up to $563,000. That's almost 600 grand. FHA continues to increase its loan limits each and every year with housing prices, but housing costs. I just find it such an incredible thing that FHA used to be looked at as a low end or lower end, housing development, lower end earners, and now they're giving out single families to 563. You buy a duplex, I think it's somewhere, I don't know, 700. You buy a triplex or a fourplex, you can get $1 million loan, live in one of those, and obviously rent those out. But for the purpose of today, we're going back to the 2025 FHA guide. We're going to talk about the different qualifications and the upgrades they've done to FHA this year to make it easier and better on buyers. Again, number one, increasing the loan amounts to $563,000. That means you probably get a $580,000 to $590,000 house with 3.5% down. That is a steal. Number two, FHA has made their rules even more flexible when it comes to credit profiles and credit score. You can get an FHA loan down to a 500 credit score with 10% down. You can get an FHA loan with a 550 score with 5% down, and you can get an FHA loan with 3.5% down as low as a 580 FICO score. They're flexible around those terms. The interest rates are still very competitive. One of the other cool things about FHA, kind of a high-level item that I really like, is debt-to-income ratio. FHA lets you honestly borrow about 10% more than conventional. Conventional tries to cut off your debt to income and your limits on your housing and all that stuff around 45% of your gross income. FHA will actually let you borrow up to 57, really 56.99, but 57. So it allows people that want to buy more house than what conventional would allow them to take an alternative form of financing, give them 12% more buying power, and potentially go out in the market and obviously buy a house that they couldn't, or rather wouldn't, had they, obviously chosen conventional financing. So easier on the down payment, easier on the credit scores, more debt to income allowed, less reserves in the bank, and more loan amounts. So now you can keep up with the cost of housing in DFW, and you're able to get a property almost $600,000 for 3.5% down. So that's a high-level overview of the pros. Now we're going to move into a couple things and separate each category and go through the pros and the cons, so we know the downside as well as the upside to all the other FHA features. So listen, FHA has strengthened their position, and it is a great loan. But what I want to talk about on topic 3 is really the pros and cons of FHA that people may or may not know. So let's go over the pros first again. So pros would be more debt to income, allowing you to buy a bigger house. The PMI on an FHA loan can sometimes even be cheaper than the PMI conventional loan. So you guys have heard before, like, hey, on a conventional loan, if I don't put 20% down, am I gonna have monthly PMI? The short answer is yes. FHA has the same version of that. It's just not called PMI, it's called MI, because it's not private mortgage insurance, it's just generic mortgage insurance that's insured by HUD. However, the difference is conventional loans, 5, 10, 15, 20% down, high credit score, middle credit score, lower credit score, that PMI can get really, really expensive. I've seen with anybody with a 660 or a 680 credit score, maybe try to do 5% down in a conventional loan, actually flip to an FHA loan and get a better interest rate. But the monthly MI on the FHA loan is 0.55%. So a lot of times, even if the interest rate is slightly higher on FHA, the monthly MI is a lot cheaper than most conventional loans, and so the total payment is a lot cheaper. So outside of it being more flexible on the guidelines and giving you more buying power, if you've got a FICO score below 680, maybe even 660, you might want to look at doing FHA because, again, the interest rate's probably comparable to conventional, maybe even a little bit better. But what really moves the needle on the monthly payment is the monthly MI on FHA is fixed at 0.55%, no matter how good or bad the credit. And that's not the case with conventional. If you've got credit that's really low, it could be twice that. So that does help people save a lot of money and is a positive when it comes to FHA. let's talk a little bit about the cons and the negative stuff on FHA that still exists, that's out there, but I'm explaining to you how to navigate around it. Number one, whenever you're presenting an offer to a seller, they can get the perception that because somebody is doing FHA and only putting 3.5% down, that they may not have very much money, that they might have bad credit. They don't know, it's all speculation. So I will tell you, it is not as strong in perception as maybe a conventional loan. However, I think the bigger step here is that the loan officer representing you needs to call the listing agent when the offer is made and explain to them, hey, this person has an FHA loan, but they chose an FHA loan. They don't have to have an FHA loan. I had clients last month that had 760 credit scores. They were really good clients. They were first-time buyers. They were going to do 5% down on a conventional loan. We ran the numbers. We put them on a FHA loan. The 3.5% down was actually a better fit. The PMI was cheaper. The interest rate was a quarter higher, but the bottom line payment was, I think, $67 cheaper. And so they like that structure. Plus, they have a little bit of debt. And sometimes people that may have 10% in the bank, they don't want to use all 10% on a conventional loan. They want to keep some of that money in the bank so that way they have money for their survival number, but also maybe there's a higher and better use of the money when it comes to, applying their hard-earned money to debt to help out with cash flow. And so they chose to default back to 3.5%. Again, not because they had to, because they wanted to, and it was a better structure and setup overall. So had I not called the listing agent and talked to her about this and explained this, they might have thought the FHA person was weaker because of the perception, but it's important that the loan officer call and give context as to why. Now, sometimes why people have to take it, and that decision is up to the seller, but it's not always the case. So don't let the perception be the reality if it's a negative when it comes to how the seller is going to view an offer with obviously an FHA financing attached to it. Appraisals. Appraisals, in my opinion, are the number one negative on an FHA loan for two reasons. Number one, they require the appraiser to be a little bit more thorough about the house, right? The house falls into a value category, so what it's worth. And then the house also falls into a condition category, and condition really falls into two separate categories, cosmetic and habitable. Cosmetic is like carpet, paint, tile, things that don't affect the livability of the property, but they're just things that the client would like to clean or fix or replace, but it won't affect the overall outcome of the loan or whether or not the fact, the people can actually live in the house. The habitability, the health and safety things are the things that are the most important stuff that because the appraisers are required to go deeper on the property, sometimes they find. These are things like foundation, HVAC, electrical, plumbing, roof, hot water heater, right? All of these things. So because FHA requires the appraisers to go a little deeper into the properties, they may discover things on those properties that need to be fixed, that become mandated to be fixed to where they may not discover those things on conventional. Now, it all depends upon what side you're on. If you're on the buy side, you like the fact that the appraiser is digging in because you want them to find everything for you, and obviously you want to have that fixed by the seller. If you're the seller, you may not want them digging into everything because they may find something and make you fix it with an FHA loan where they wouldn't with the conventional. So there's some pros and cons on that, but the appraisals are really the things that are the toughest on these loans. And last but not least, if you're a seller and you accept a buyer's offer with FHA financing and an appraisal is done on the property and the value comes in low and you guys cannot meet, on terms and everybody decides to terminate and go back to the market. If you as a seller go to relist your property, you cannot take another FHA buyer on that specific home because an appraisal has already been done. And if the appraisal is low, that appraisal sticks with the property for 120 days. Okay, so be mindful of that when you accept an FHA buyer. Hey, they could be, taking it because they want to. They could be taking it because they have to. When it comes to your property, the appraiser is going to do a little bit more digging on the property. If they find some stuff and it's cosmetic, don't have to worry about it. If they find some stuff that's health and safety, you're going to have to worry about it, get it fixed. But when it comes to overall value, just for an example, say you got your house listed for $300,000, the appraisal comes back at $292,000. You guys can't reconsideration of value, can't come to terms. Everybody wants to terminate, go back to the market. You can relist the house at $300,000. You just can't take an FHA buyer. You would have to take a conventional buyer or a VA buyer or a cash buyer, anyone other than FHA, because FHA appraisals stick with the specific property for 120 days. And so if you go to relist, right, the new FHA buyer is going to be out of the equation. So that's something to consider. And remember, if you are listing and or taking offers and accepting offers with a current FHA loan on it when you are the seller. And last but not least, number 4, FHA allows for a lot of down payment assistance, as long as you qualify from an income standpoint. So the 3.5% down that's required for the loan program can be given to the buyer or buyers from the county. There's a lot of different type of down payment assistance programs that you really can get in for basically zero down if you're getting some type of down payment or bond program. And then in conjunction with that, FHA allows up to 6% of the sales price for the seller to contribute towards closing costs. Now, this is where the magic happens, because if you are buying a $400,000 house and you can get 6% seller concessions on FHA, you can, in theory, you get the seller to pay $24,000 towards closing costs. Well, we all know on a $400,000 house, there's not going to be $24,000 in costs. There's probably 10, maybe 12. So then people say, well, Brian, you know, if I get $24,000 and I'm using 10 of it to pay for the closing costs, what do I do with the extra 14? Good question. Most people take that money and do what's called a temporary interest rate buy down. All that means is wherever the interest rates are today, and just for an example, I'm going to say 6.99 is the actual rate. You can buy that interest rate down either 1%, 2%, or 3% lower for 1 year, 2 years, or 3 years. And how you determine how much you buy the interest rate down and for how far and how long is however much leftover money that you have from the 6% seller concession can be contributed to it. So if a 3% 3-year deal was $20,000, well, you couldn't do it because you've only got $14,000 left over. But if a 2% 2-year buy down was $13,000, then you could do it, right? So this is a very smart strategy that FHA allows. It is 6% of the sales price on all transactions. There's obviously not going to be that much in concessions that can be used towards closing costs, but what most folks do is take the extra money and turn around and do some version of a temporary interest rate buy down, so that 6.99 may start out at 3.99 or 4.99 for the first few years, giving you extremely cheap payments at the seller's expense and effectively giving you a future rated payment at a current house price right now at the seller's expense. And if you end up refinancing, which most people will probably, in my opinion only, by Christmas of 26, any of that unused money on the temporary buy down comes back as a full refund to the consumer. So any of that additional money that they use from the seller to buy on the interest rate, if they don't keep the full 24-month term or 36-month term, however long that they choose, the prorated portion that's still left there goes back to them as a refund and effectively probably pays for the refinance the next time around. Or you can even use some of that money for permanent discount points when you're refinancing to try to get the rate down lower forever. And so sometimes the seller is effectively paying for your interest rate buy down twice. The first time around, the temporary one for maybe a year or two until it's time to refi, and then whatever the leftover is goes back to the consumer, and they could use that to cover any of the buy down or any of the costs associated with the refinance in the future. So listen, I hope you found this video useful. If you did, do me a favor, like, comment, subscribe, even share it with somebody that you know that could benefit from this information. There's a lot of information out there in 2025, and I think knowledge is power. If you're anybody that you know just wants to have a consultation, talk about your pre-approval, talk about your home buying or selling journey, and you want to connect with us, do me a favor, call us, email us, text us. We're always here for you. Until next time, stay tuned.